Warren Buffett is the best investor of our time. He's amassed an $80 billion fortune by sound investing principles combined with a very long-term time horizon. What's really amazing is that his strategy is not that complicated. It's easily repeatable by investors like you and I. In today's video, I'm going to share with you Warren Buffett's 3 cornerstones of sound investing. The first cornerstone of sound investing is to look at stocks as though they are pieces of businesses. Warren Buffett is a firm believer that stocks are not pieces of paper to be traded back and forth. Instead, they represent an actual fractional ownership in the underlying business. The following quote from Buffett is very illustrative when it comes to this fact. We, Warren Buffett and Charlie Munger, do not view the company itself as the ultimate owner of our business's assets, but instead view the company as a conduit through which our shareholders own the assets. Shareholders benefit from this type of thinking because it allows them to be long-term investors. When you understand that you're a part owner of a business, you're going to act in the long-term interests of that business, which doesn't mean trading back and forth. Long-term investing is very powerful because it causes investors to avoid capital gains tax and take maximal advantage of compound interest. The second cornerstone of sound investing is that volatility is your friend, not your enemy. Warren Buffett has long believed that harnessing volatility is one of the main reasons why he's able to compound his wealth over time. The Mr. Market analogy is a great example of how this phenomenon is true. Benjamin Graham is the creator of the Mr. Market analogy, and he writes the following about it. Imagine that in some private business you own a small share that costs you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or sell you an additional interest on that basis. Sometimes his idea of value appears plausible and is justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away from him, and the value he proposed seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in the case you agree with him, or in the case that you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price, or equally happy to buy from him when his price is low. But the rest of the time you will be wise to form your own ideas of the value of your holdings, based on full reports from the company about its operations and financial positions. Buffett believes that market prices should be seen as opportunities to buy or sell, not as obligations to buy or sell. It should also be noted that profiting from short-term volatility in stock prices is very different from short-term market timing. Buying a stock because it's cheap and you expect it to become less cheap over time is very intelligent, but making short-term predictions about movement of security prices is not. Warren Buffett's third cornerstone of sound investing is to invest with a margin of safety. A margin of safety is the difference between a security's purchase price and its intrinsic value. Now, it's a little bit of a tricky concept because real intrinsic value is completely unknowable. Theoretically speaking, a company's intrinsic value is its future cash flows discounted back to present value at an appropriate discount rate. In practice, however, intrinsic value is unknowable, but the concept is powerful nonetheless. As an example, imagine that you have the ability to buy a stock for $70 and you believe that that stock is worth $100 in reality. Your measure of its intrinsic value can be 30% wrong and you'll still break even. For this reason, a large margin of safety allows your predictions to be quite inaccurate and you'll still profit over the long run. Many of the world's most successful investors have made great use of the margin of safety over time. For examples, consider the following quotes. A margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Seth Klarman, the billionaire founder of the Baupost Group. Leave yourself an enormous margin of safety. You build a bridge that a 30,000-pound truck can go across, and then you drive a 10,000 truck across it. That's the way I like to go across bridges. Warren Buffett. Confronted with a challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. Benjamin Graham, the father of value investing. In today's video, we shared 3 cornerstones of Warren Buffett's sound investment strategy. These cornerstones are 1. Treat companies as though they're fractional shares in an underlying business. 2. Seek to profit from short-term volatility in stock prices. 3. Invest with a margin of safety. Thanks for watching today's video, and we invite you to subscribe so that you can stay tuned with the latest investing content from ShareDividend.